Good afternoon, everybody, and welcome to Toronto Finance International's second Small Business Lending Educational Webinar. Today, you'll hear from Jenna Hay on understanding your credit score, what it is, why you need it, and how you can use it to grow your business. There will be time for questions and answers at the end, so please send them in using the Q&A section available on your screen. As Head of Policy and Regulatory Affairs at LendLoop, Jenna works with industry, governments, and regulators to help find solutions to a number of problems faced by small businesses, especially when it comes to accessing capital. Growing up with parents who were small business owners, Jenna has always been passionate about increasing economic opportunity in Canada. Prior to joining LendLoop, Jenna was a senior policy advisor to Ontario's Minister of Finance, where she oversaw a number of key financial services files, including delivering a first-of-its-kind fintech strategy and advancing the creation of a national securities regulator. It was there that she first saw how fintech could be used to help solve important economic and public policy challenges. With that being said, I will now hand you over to Jenna to talk you through this educational webinar. Thanks, Jenna.
Thanks, Leslie. Hi, everyone. I hope you're doing well this afternoon. It's a bit of a gray and kind of rainy day here in Toronto, so I hope your weather, wherever you are, is a little bit better than mine. Leslie, thanks for that kind introduction. And for those of you who were on the last webinar that talked about alternative lending, the company that I'm with, LendLoop, is an alternative lender. We work with companies looking to access financing by connecting them with different retail and institutional investors across the country. We can talk a little bit more about that later, but today I'm actually here to talk to you about understanding your credit score. As you know, the title of this presentation is What It Is, Why You Need It, and How to Use It to Grow Your Business. So I'm going to give you a brief overview of the webinar itself, what we're going to go through, and the Q&A session at the end. So I'm just trying to move my slides over here with a bit of challenge. Until I can get that sorted out, I'll just run you through it. Today we're talking about credit scores because credit's actually a really important thing to be talking about. It's something that you tend to need most when you're growing your business. I talked to a lot of small business owners who have bootstrapped it from the start. They often bootstrap it along the way, and then they reach a certain kind of critical point of growth in their business, and they realize that they really need a loan. And then suddenly your credit score becomes very, very important. But like anything, it doesn't grow overnight. It doesn't change overnight. It's something that needs to grow over time. So knowing a few key aspects of it and knowing the strategies that you can use to build it over time will give you a really great credit score that will put you in an excellent position when you need it. So today is really about understanding some foundational things about what makes up your credit score, understanding why it actually matters and how it plays into the growth of your business. We're going to go through a few common and unsuspecting things that hurt your credit score, things that might not be intuitive that you could be doing that are inadvertently hurting it, and then some strategies for improving your credit score. If you're suddenly realizing that you need to increase your score, or if you want to maintain a good credit score, how you can go about doing that. And then we're going to go through a bit of a Q&A so I can answer some of your questions and clarify. So the key thing with understanding your credit score is knowing really what it's about at the end of the day. And at the end of the day, it's about predictability and risk. It's about companies knowing a little bit more information about you and having some sort of indication of your ability to pay off loans that are lended to you, pay off credit that's extended to you, doing so in a timely fashion, and doing so in full. And so what we're really going to be driving through today are some key foundational aspects of that. And thanks for your patience. We're perfect. Now we're getting through the slides here. So went through the webinar overview there. Getting into understanding your credit score and why it matters. Here we are at risk and predictability. So really it is about companies getting a sense of what it would be like to lend to you and your ability to pay back. So when we go through a few foundational things, there are a couple of things I want to cover off right off the top. First off is just the difference between your credit score and your credit report. Your credit report is essentially a summary of your credit history. So when I talk about what your credit history is, I'm talking about activities related to when you borrow money or when you apply for credit. So how much are you borrowing? How frequently are you borrowing? How often are you paying it back? those types of things. Credit reports are produced by credit bureaus. They're also called credit reporting agencies, so you'll hear those terms used interchangeably. We'll get into a bit more detail as outlined on this slide. Your credit score is a little bit different. This is part of your credit report, but really at the end of the day, it is a number that reflects the information that's found in that report. It's designed to give sort of a quick indication of how risky or reliable you are likely to be if you're extended credit. And the calculations behind it and the formulations behind it are actually quite complicated and confidential, but there's a very simple underlying concept at its core. Credit scores are essentially a point system. When you do things that show you are responsible with your credit, like paying off your credit card bill in full, on time every month, you gain points. When you do things that show that you might not be responsible with your credit, like missing a credit card payment, let's say, you lose points. And that's really what it's about at the end of the day when we're talking about your credit score. And it's important to understand that really basic concept of that point system. Now, it's important to remember a very key thing as we start to go through this as well. Credit and credit scores are always a balancing act. The best way to show that you're trustworthy with credit is to actually use it and use it responsibly. No credit is almost as bad as bad credit. So when we talk about different strategies around credit, it's important to remember this really foundational concept that in order to build good credit, you need to be using credit. You need to be demonstrating a bit of a history, if you will. The absence of credit history really just shows an uncertainty, which brings us back to this predictability point. Companies, lenders would rather know what you've done in the past than not have anything to work with at all. So that's something good for you to keep in mind when you're considering what we're talking about here. So now that we have that really basic sort of foundational piece of what the difference between a credit report and your credit score are, let's talk about just some other key aspects for you to know when understanding what these things mean in terms of everyday life in your business. There are two major credit bureaus in Canada that issue your business credit score, and both bureaus use different factors to calculate your credit score. The first one is Equifax, the second is TransUnion. We're going to break these down on the next slide a little bit more. They each use their own scoring and scoring range. They use their own calculations, but there are similarities between them, and they're both used by different types of lenders to access information about your credit history. Your credit score, which we just talked about a little bit, what it is really used to help lenders of any kind. So we're talking banks, different alternative lenders, for those of you who were in the last seminar, understand your likelihood of paying back your loan, or what we often refer to as your credit worthiness. That essentially means that your credit score is one of the biggest factors that affects your ability to get a loan, period, and then the terms of that loan. So how much financing you can access, the interest rate you can get, essentially the quality of that loan and getting the loan you want or need. Your credit score is going to play a role in that. It's not everything, but it's a big role. And then at the end of the day, your credit score is, your credit score for your personal credit score is different than your business credit score. We're going to get into a little bit more detail of how you build up each, what the differences are, and why you might want to use one or the other. But essentially, you need to know that those two things are very different, but they both go up and down depending on the actions that we've talked about. One thing that you should note on your credit scoring credit report is that the credit bureaus follow rules that define who can see your report and how they can use it. Equifax and TransUnion, which I mentioned, are private companies that collect, store, and share information about how you use credit. They collect information about your credit here in Canada. So if you have credit experiences outside of Canada, that's not going to factor into your credit report here. But they do follow certain rules about how they can use it and who can see it. The types of groups that can see your credit report include banks, credit unions, other financial institutions like that. Might be a credit card company, car leasing company, let's say, insurance companies, things like that. So now that we have a few of the foundational pieces of understanding kind of the foundation of your credit report and your credit score, we'll go into what makes up your personal credit score. This chart here is a really good just sort of overall view of what makes up your credit score. Credit scores are not an exact science. So it's something to keep in mind that these aren't sort of perfect numbers, but it is a good overview. If you look at something, let's take the largest amount, payment history. That's really looking at your credit cards, that's really looking at your credit cards, let's say, how much you took on, when you took on that debt, what exactly it is, and did you pay it back on time? It's really looking at all the different lines of credit you've taken out, be it credit cards, be it term loans, things like that, the amounts, your repayment history, and a few other things like that, really around sort of that timing, which goes back to that reliability piece that we talked about. The next largest percentage is your outstanding amounts owed. So of the credit that you've taken out, how much is left that you need to pay off? And that intersects a little bit with your payment history as well. Then we get into the length of your credit history. So looking at how long you've had certain credit cards or lines of credit for, different term loans, things like that. We're going to get into a bit more detail about how the length of your credit history can be affected by different things like moving over credit cards, but that certainly plays a role. And then very closely related to that is new credit. So really, when we talk about new credit, we're talking about opening up new accounts. So for example, if you're opening every single credit card that's offered to you by a retailer or a store, why are you doing that? That's sort of the question that's going to get raised. Are you looking to get your hands on as much capital as possible? Or are you looking at just opening up more accounts so you have that accessible? Things like that are really important to consider when you're considering building your credit. And you can build it up in a measured way without opening every single account that's suddenly available to you. And then the last piece of it is the types of credit, which we talked about. So different credit cards, lines of credit, and term loans. When we get into the credit scoring itself, we talked about the two major companies, Equifax, Beacon, and then TransUnion. We talked about how they each have their own calculations and formula that play into the production of your credit score. And so we've got a little bit of a list here. It relates to the slide we just talked about, but they do have very specific types of information that they look at and include in their calculations. So when you look at something like payment history, they're both looking at that, and that's going to play a key role in how they calculate your credit score. They're going to look at use of credit versus available credit, which we call credit utilization. We'll talk about that a little bit more. Then you get into a few differentials. Like for example, if you look at Equifax Beacon, you're looking at the risk of default that you've had in the last 24 months versus TransUnion, which may put more emphasis on how often you're applying for credit and how that might influence your behavior. So there's a couple of different things to remember. There are a few core foundational pieces that they will both look at, but they do have a few different pieces of information that they collect individually and weight differently, which is why you're going to get slightly different scores between the two of them. You'll also note at the bottom of the slide that the scoring range between the two is is somewhat different. Generally, and this is a general rule of thumb, good credit is around 750 or above, is often what's considered good credit, but that can really depend on the circumstance and the request. But that's something for you to keep in mind. So we talked about business credit and personal credit a little bit and the difference between the two. This is a really important thing for small business owners to be aware of because it can affect different opportunities you might have in the future. It's a great idea to build up your business credit if you haven't already started doing so. And the reason is that as a small business owner, so much of your personal life is really tied into your business. When you are building something, it's taking up pretty much all of you in your life. As you grow and as your business grows, it's a really good idea to start disentangling the credit side a little bit. Because of what's involved with putting things on personal credit, you may have to, for example, wind up putting a lien against your house. That might not be something you want to do for your business, or that might be something that you want to reserve for personal situations. When you build up credit within your business, you can then secure against assets within the business, potentially, and allow you to not only build up an excellent business itself, but an excellent credit history behind that, which is going to allow you to leverage that business more than you would if you just had your personal credit history. But there are certain things you need to do in order to actually start building up your credit history for your business specifically. First off, you have to take a step back and think about what it means to start building up if you haven't started at all, which means that you may need to start small. If you remember when you got your first credit card, you probably had a limit of something like $500 for your first personal credit card. But as you built up the credit, as you paid off your monthly payments and you did so on time and you demonstrated that you were reliable, that probably grew to 10, 20 times that over time. It's the same thing with your business. You may have access to a business line of credit that's quite small. Start there, build it up, let it grow over time. Rome wasn't built in a day. Your credit line is not going to be built or your business credit is not going to be built in a day either. There are some really specific ways that you can build up your credit score too for your business. The first is apply for and pay off corporate credit cards. So we talked just a minute ago about personal credit cards. You can do the same for corporate credit cards. There's something that's important for you to know, which is if you're looking at corporate credit cards, just clarify with the financial institution you're with that it will build up your business's credit score. Sometimes personal credit cards can be advertised for business purposes, and so it's just something you want to ask when applying to make sure that it's actually doing what you want it to do, which is building your business's credit score. Typically, they're called corporate credit cards when they're going to build up the business's credit. That's a bit of a keyword you can pay attention to, but it's always good to clarify that. The second is look for other lines of credit you can open. And the example here is supplier-provided lines of credit. So you may have an existing relationship with a supplier or a vendor, and there might be an opportunity for you to do that, to open this line of credit with them and build it up over time. That's one perfect example of ways that you can build up your credit and demonstrate that specifically tied to your business. The other thing you can do is if you are a business owner that leases equipment, you can ask your supplier if they provide payment information to credit reporting bureaus. So you specifically want to clarify this because obviously you want to make sure that information is going there. But if that supplier does, and you're making your payments on time, that's going to absolutely boost your business's credit score and help out in that regard. Certainly help strengthen it. You want to make sure that that's something that you really want to be taking into account too. You may have a company that leases equipment and the supplier doesn't provide that repayment information. And in that case, you're really going to want to make the calculation as to whether or not you need to be building up your business's credit score and switching suppliers or sticking with the one that you've got and recognizing that it's not going to contribute necessarily to your business's credit score. Either way, it's a great question to be asking and something to be keeping in mind. And then the last thing is that you can take out a loan with a lender that provides repayment information to credit reporting bureaus. So for example, the company that I work with, Lending Loop, we do this. We provide information to these bureaus. And so if you take out a loan, which is generally a term loan, can be over several years, you can build up that very specific aspect of your credit. It's a little bit different than a revolving credit card. Term loans tend to be for higher amounts, and they can build up a very specific aspect of your credit history. So that's something to keep in mind as well. And then ultimately, you want to keep in mind, build it now for later. You may not need this right away, but down the road, chances are you will, and it will be very helpful to you if you have it built up already. So now that we have some foundational pieces covered off, we're going to talk a little bit more about things that actually hurt your credit score that are a bit unsuspecting. There are things about building your credit score that are pretty intuitive, and then there are things that may be a bit surprising, habits that you're maintaining on a day-to-day basis that over time are going to erode your credit score. And we're going to talk about some strategies afterwards of how you can improve that over time. So a very big issue that people have when it comes to hurting their credit score is high credit card utilization. So credit card utilization is very simply put the ratio of the credit that you're using versus the credit that's been extended to you. So the example I have here on the screen is that if you have a credit card limit of $30,000 and you're carrying a balance of $26,500 on it, that means your utilization is about 88%, which is quite high. The Financial Consumer Agency of Canada recommends a ratio that's no higher than about 35%. So ideally, what you want in this situation is to have more credit available to you than you're using. You want that limit, the amount that you have taken out and used in that credit, to be much lower than what's been offered to you. There are debates around what's good in terms of the lowest ratio. Some people say that it should be closer to 25. The FCAC recommends 35. Somewhere in that range is good. It's going to be sort of negligible at a certain point in terms of improvement on your credit score. But really, 35% is sort of the ideal. That golden rule of 25 to 35 is very useful. In terms of credit utilization, a big thing that you want to think about, and we'll talk about this in strategies, is how, if you currently have a high credit utilization, you can improve the amount of credit that's extended and available to you that you're not using. So if you have a high credit card utilization right now, let's say you're looking at this $30,000 number and the 26.5, and you're doing some basic math and going, okay, my credit utilization is quite high on my credit card. Keep this one in mind because we're going to address some strategies after, but refinancing that is an option for you. And we're going to talk about that a little bit later on. So think about that one. When it comes to credit card debt, only making minimum payments is a big problem. Like credit card utilization, debt does play a role in your credit score. It also is going to hurt your cash flows. So having that outstanding debt can be problematic, and only paying off the monthly minimum is actually going to hurt you overall, because that debt accumulation that comes with the revolving interest that comes with your credit card can eventually become nearly impossible to overcome. It's a common misconception that some people have with credit cards that paying off the monthly minimum will result in the same outcome as paying off the balance in full every month. It actually doesn't. The interest can accumulate very quickly over time. It tends to revolve on a daily basis. So that interest that you're building is compounding very, very quickly, and it can become insurmountable. So you want to keep an eye on making minimum payments only, because that's going to hurt you in a myriad of ways. But one, at the end of the day, is going to be your credit score. The third thing that you want to think about in terms of things that can hurt your credit score is shopping around for loans. You may be interested in getting some financing and you want the best rate possible. That is a great thing to do, and you should be shopping around for the best options and lowest interest rates for you. But you want to be careful about how far you go in the process. There are certain types of inquiries or applications that can actually negatively affect your credit score. And what happens when you apply for credit and go through a certain point in the process is that it can be what's called a hard hit on your credit. Hard hits are where it essentially reaches a threshold where you are considered to be needing and applying for that credit, even if you're not sure you want to access it. So when that happens, if you've done that multiple times, those hard hits are going to result in a negative effect on your credit score. A really good thing to remember is to ask, when you're looking into credit options, whether or not there's going to be a hard hit or a soft hit on your credit score. A good lender, just as a note, will tell you whether or not something is going to result in a soft hit or a hard hit. But those are two sort of key terms you want to keep in mind. Soft hits, no problem. Soft hits are going to not have any effect on your credit score. It's just an inquiry. Like, for example, checking your credit score is not going to result in a hard hit. It's just going to be a soft hit. But going through certain loan applications, or which are sometimes called loan inquiries, so be careful about the terminology, can result in that negative impact on your credit score, which ultimately, when you do need that money, can make it harder to access, or can mean you have to pay a higher interest rate as a result. Some other things that can hurt your credit score include missed payments and delinquencies. So this is one that actually is often something that people tend to not think affects them too much, especially when it comes to small payments. But missing payments of any kind, big or small, are going to have a negative effect on your credit score. And that really goes back to what we were talking about at the beginning, which is that reliability and predictability. What's the risk that you're not going to pay back this loan? Missing payments can really affect that. Multiple delinquencies will have a significant impact. And these are also things that can stay on your credit report for a long time and affect your credit score for a long time. Judgments and collections also fall into that. So debt collections can negatively affect your score. And a key thing to remember here is even after you've paid off the balance. Same thing with judgments, which are debts you owe in a lawsuit. They will also affect your credit score because it goes back to that reliability issue. I want to talk for just a minute about negative information being kept on your credit report. Things like late payments, bounce checks, missed payments on debt, those types of things, they can stay on your credit score, or your credit report rather, for upwards of around 6 years. There are different pieces of information that stay on your credit report for different periods of time. And ultimately, that goes back to what the item is, the province you live in, and the credit bureau that created the report and has collected information on that. So if there's a specific issue you are seeing on your credit report that you have a question about, you should call the credit bureau. But generally speaking, negative information is kept on your report for around 6 years or so. So that gives you a sense of how these things can build up over time. If missing payments are happening on a regular basis, it may feel like it's not too big of a deal, but it actually is, because those things tend to accumulate over time and they tend to stay. So these are a few things that obviously can hurt your credit score. And if anyone is looking at this and starting to think, uh-oh, don't worry about it. I'm going to jump into some strategies for you that can help you improve. If these aren't issues for you, there are also great opportunities to implement these strategies, maintain a good credit score, even improve it a little bit more over time. So we'll get into those now. Before I jump into these tips, I just want to clarify one thing because some of our slides weren't working at the beginning and it was on one of them. These tips that I'm going to give you are great strategies and general strategies to use. You really need to know what is affecting your own personal credit score. And the best way to do that is to look at your credit report. The intent of these tips is really to be educational in nature. It's really things that we know generally results in improvements to people's credit scores, but we can't guarantee that any one of these tips is going to directly affect your credit score. The best way you can find out what's affecting your credit score and how to improve it is to look at your credit report. And I'm going to give you ways you can do that towards the end. But just something to keep in mind, these are general strategies that people use and execute and can be very helpful in improving your credit score, but we can't guarantee that it's going to specifically improve your exact score. You'll have to look at your credit report and start implementing these things over time to see where the issues are. But with that, we'll dive right into it. So the number one thing might seem a bit obvious, but it is a very true one. Make your payments on time. Also included in that is making your payments early. So all the bills you have, pay them when they're due or before. This includes phone bills, any outstanding credit that's been loaned to you, anything that is like a credit card, which is on a revolving basis, or term loans where you have monthly repayments of principal and interest. This is one of the very best ways you can demonstrate your reliability for the credit that's extended to you. Sometimes life does happen and you can't make a payment for whatever issue, either that month or on time. If that happens, you should contact the creditor right away. And I say this because a good lender will work with you to get you back on track if there's an issue. Ignoring the problem is not going to help. Contacting the lender, explaining the situation and seeing what you can work out may help you in the long run. And it will also demonstrate a good lender to you. For example, sometimes at Lending Loop, we have small business owners who have issues with cash flow. difficulty repaying something, maybe just for 1 month, when they call us and they talk to us, we can work with them to get them back on track rather than having the issue compound over time. So, good rule of thumb, always make your payments on time. But if you are having an issue, don't ignore the problem. And remember, refinancing is an option if this is an issue for you. We're going to talk about that in just a minute. The next thing is working to lower your credit utilization. So what this really means is if you have a high credit utilization, let's say it's well above that 35% threshold we kind of talked about, pay off the debt as much as you can to start lowering that. The other thing you can do is leave those accounts open, even if you're not using them, to have that credit available to you that you're not using. In certain cases, you can also raise your credit levels. So a really good example of that is a lot of times your bank will call you up, let you know that you've been pre-approved for a higher credit limit. You can accept that raised credit limit, but the key here is not to utilize that newly available credit. You want to keep that utilization below 35%. That is a really, really important thing. If you're going to use that credit that's become available, you're only going to compound the problem. So make sure you kind of stick to that golden rule of 25 to 35%. If you're higher than that, you can lower it over time. Again, if you're very, very high on credit card utilization, refinancing is an option. But the trick here is really, if you have the discipline to look for ways you can increase the credit that becomes available to you without using it. So you really hit that 25 to 35% sweet spot, if you will. And the other thing to remember here with the credit utilization is stay within that sweet spot, but make sure you are using that credit. You don't want your utilization to be close to zero, because that really means at the end of the day, you're not demonstrating that you can take on credit and repay it. So that's something to keep in mind, that balancing act, if you will. The third thing is you want to increase the length of your credit history. And this is one that often gets a lot of people. Having any kind of credit account open for a longer period of time is going to help you build your score. So what that means is, for example, leaving credit card accounts open. One thing you need to keep in mind is that if you switch credit cards, let's say, from one account to another, even if you're transferring over the balance of that credit card, it's considered new credit. So that's one that we often find people don't realize. They may get a better deal on another credit card, or they like the point system available, that type of thing. Those are all great things to consider, but one of the things that you should consider is whether or not you're causing problems to your credit by jumping around all the time and opening new lines of credit, rather than demonstrating that you can hold credit for, let's say, 10 years instead of 1. So that's something to keep in mind. If you're finding that's an issue with your credit score, if you think, oh, that's me, I tend to jump around, think about maybe keeping one credit card open for longer periods of time, or different forms of credit open to demonstrate longer periods of time. The other thing you can look at here is whether or not you need to take on a term loan. That could be 2 to 3 years in length, maybe a little bit more. And having that length of credit history where you're constantly repaying the interest and the principal over time demonstrates that you can take on more and for longer periods of time and still manage it. So that's one to keep in mind. There's a couple more. I referenced refinancing your credit card debt. That is a big one. This can also apply to other forms of debt that are very high. We tend to think about these types of forms of debt as being ones where you have to repay interest, and interest is calculated on a daily basis. When interest is being calculated on a daily basis, that's often a signal that it's going to compound over time and can become overwhelming. So if you have a lot of credit card debt or other high interest debt that's being calculated on a daily basis, there are options available to you, and they will likely help your credit score significantly. Refinancing credit card debt so that you're paying a lower amount of debt at the end, or a lower amount of interest rather, at the end of the day, and paying it off in installments can help you a lot. There are a number of options to help you refinance your credit card debt. One example is taking out a term loan, let's say, at a much lower interest rate. It's something we see somewhat frequently at Lending Loop, where we have different small business owners who have taken on very high interest debt. They want to refinance that, they want to pay that off, and then start paying much lower interest rates over time. That is an option for you. And certainly I have some tools available to you if you find yourself in that situation. The next thing you can do is you can reduce your applications for credit. So this is for those of you who may be looking at what's available to you in terms of loan amounts, interest rates, terms, all those things. Reduce the actual applications. You can make inquiries, but always remember to ask whether or not there will be a hard hit or a soft hit on your credit. Reducing the number of applications for credit, if you're actively doing that, is likely going to result in much fewer hard hits on your credit, and it's going to result in likely a higher credit score. An important thing to differentiate here very quickly is that checking your credit report itself is not going to result in a hard hit on your credit. It's kind of like if you log in to view your bank account, you can log into your account as many times as you want, but that number is not going to change. It's the same thing with viewing your actual credit report. It's never going to have an effect on your credit. Sometimes that's a bit of a rumor that goes around. Checking your report, checking your score is only ever going to be what we call a soft hit, but actual applications for credit itself can often result in hard hits. So you want to remember that you always want to ask whether or not it's going to be a soft hit or a hard hit. As a general rule of thumb, pre-approved loans like those that you get sometimes from your bank or local financial institution where you're pre-approved for an increase or a line of credit, those are usually considered soft hits. So you don't need to worry if a financial institution is proactively giving you that information that there's been a hard hit on your credit. Those are generally soft in nature. And then the sixth tip to help improve your credit score is to always read the fine print and ask questions. This is specifically if you have taken out credit or you are taking out credit. There are a couple of things that are sometimes hidden in contracts that can actually really hurt your credit score and ultimately your cash flow in the end. One of them is automatic loan top-ups. And so what that really means is sometimes this can be built into contracts. You tend to find this in the alternative lending space. It's not all, but it can happen, where when you reach a certain point, your loan gets topped up, regardless of what you've paid back. So sometimes you may just want $100,000 in a loan, but you're automatically opted in to a system whereby when you pay off $50,000, you get topped back up and have more of a loan. And that tends to happen automatically. So that's something you want to look for in the fine print of a contract, because you'll ultimately be taking on more credit and that could hurt your score at the end of the day. Checking for that and opting out of that, or looking for another option in terms of lending that's available to you, is likely going to help. The other piece that is often sort of hidden away in fine print, if you will, is not offering discounts for early repayments of loans. So really what that means at the end of the day is if you take out a loan and it is a term loan over a certain amount of time with a certain interest rate, if you happen to have an influx of cash flow or something else that allows you to repay that loan early, finding a lender that will allow you to do that and essentially do so what we call at a discount means that you're not going to be further indebted by essentially what works out to be like a fee of sorts for early repayment or increased interest rates. That's something to keep in mind. Again, in the fine print, you can simply ask, what happens if I want to repay this loan early? And the lender that you're talking to should be able to outline for you in detail whether or not you'll essentially be affected by wanting to repay a loan early. So those are a couple things that are kind of hidden away that people often don't think of. A, it's a great thing to know when you're looking at loans, but B, these are also things that can ultimately affect your credit. So those are some of the tips I've got for you in terms of really practical ways that you can improve your credit score. And we've talked about a lot today. So I'm going to give you sort of my top 10 list of things to remember overall when you're considering your credit and your credit score. So the first one is just remembering that your credit score is about your risk profile as a borrower. It's about predictability. It's about really guessing what the likelihood is that you are going to be responsible if you take on more credit. So when you take different actions related to credit, keep that in mind, because ultimately your score is designed to reflect that point system you get for demonstrating you're responsible with credit versus not. A good credit score really means more and better financing options for you. We talked a little bit about why credit matters. Well, if you're growing your business, you want the best financing options available to you. You want to be able to get the loan amount that you ideally need on better terms, be it the length of time that you can amortize it over or the interest rate. A good credit score is going to help you have more options, period, and then better financing options. One of the things we didn't talk about that I'll just briefly touch on too is understanding your credit score and why it matters. Checking in on your credit score will also help you know if there's any issues with fraud or identity theft, things like that. So being aware generally of your credit score is good for things like that as well. Remember the rule of thumb, which is that credit utilization should be no higher than 35%. That sweet spot is really 25 to 35%, generally accepted, but you want it no higher than 35%. You want to make your payments on time, and a really easy way to do this is to set up automated withdrawals. If just simply remembering to pay certain bills on time is an issue, in most cases you can set up these automated withdrawals. You can do it through your credit card, and so you can still review the payments before your credit card is due, but you're not missing those cell phone bill payments or things like that that can ultimately really hurt your credit, especially if you have multiple issues with that happening over time. You want to watch out for your credit card debt and look at refinancing options. So when we talk about credit utilization, if you're doing some quick back of the napkin math and you're saying, okay, my utilization is a lot higher than 35% on my credit card, look at what refinancing options are available to you. It might be through a term loan where you can take on that refinancing, pay off that credit card debt right away, and then pay lower interest rates over time. Remember when you're shopping around for a loan to limit the number of credit applications or credit checks that you do, because you could result in hard hits on your credit. And the follow-up one to that is if you do apply, a couple of things to remember, try to space them out a little bit. So try to do so maybe over 2-week periods of time. If you're just curious and you want to get a good sense and you're thinking of applying, spacing them out will help a little bit. And then also ask about whether or not it's going to be a hard hit versus a soft hit and make a decision accordingly. If you're just curious and you don't really need to know the terms of that loan, let's say, maybe you don't want to make that application right now, or maybe you want to find other ways that you can inquire that are only going to result in soft hits. But really remembering sort of the simple concept of if your behavior is showing that you are looking for a lot of credit in different places all at once, that may signal something that makes reporting agencies a bit nervous in terms of your behavior, even if maybe that's not what's really going on. So just thinking through how you apply, when you apply, spacing out those applications, looking for inquiries that result in soft hits, and limiting the number of ones that you fully apply for that result in hard hits are going to ultimately help your credit score in the end. And then the next one is really try to build and utilize your personal credit score, your business credit score over your personal credit score. And what we talked about there is really tying things into your business itself and disentangling your personal life from that a little bit. So really looking at corporate credit cards, just remembering to ask when you're applying for a credit card that directly affects your business, making sure that that credit card will build up your credit score for your business. So again, typically they're called corporate credit cards, but it's worth asking if you're going in that route. So try to build up and utilize your business credit score. over time, because as you build that up, you will be able to draw down on that more rather than having to lean on your personal credit score as much, which you might want to leave your personal credit for personal matters. Checking your credit score is not going to hurt your credit score, and it's really good to check your credit report. Every so often you can check it quarterly. Some people like to check it as much as monthly if they're looking at possibly getting a loan in the near term. But checking and understanding your credit report is not going to hurt your credit score, and it's a great thing to do because typically when you use services that check your credit report, they will often indicate what's affecting your credit score and how you might be able to improve it. So while we talked about strategies here that can practically improve your credit score, there are also perhaps even more personally tailored ways that you can improve your credit score that you're going to get from services that allow you to check your credit report. And then the last thing just to remember is there are no quick fixes. I say these things are scams because anything that's claiming to fix your credit overnight or your credit score overnight is not going to happen. I think earlier I used the little quip that Rome was not built in a day. It's really true with your credit score. Have patience. If you employ the right tactics and the right strategies, you will see your score build over time and go up. But it is going to require a little bit of patience, which is why it is a great idea to start now for later. So those are sort of my top things to remember in terms of understanding your credit score and your credit report and the kind of key tips and tricks you can do to improve your score. I hope these have been educational for you. I certainly love talking about credit with people and demystifying credit scores for people. There are really practical things that are listed on these top 10s that you can do that will ultimately likely have a very positive impact on your credit score. So I hope that you were able to take a couple of notes. But now I'm just going to go into the Q&A and see if there's any questions that folks have around that. So I'm just pulling that up. Sorry, I'm just taking a look. So there are some questions about the lending process and interest rates given. For those of you who weren't in the last seminar that was really focused on the alternative lending space, it really varies between lenders. Interest rates are something you're going to have to ask about with different lenders. Certainly the company that I work for, Lending Loop, is really the one that I can speak to. We offer, as an alternative lender, a range of interest rates depending on your risk profile. And so really, I would inquire. You're more than welcome to visit our website, lendingloop.ca, to ask about interest rates, but I can't really talk about too much about the different range of interest rates available for different businesses. But I believe there was a previous seminar or webinar that is available from TFI that talks more about the alternative lending space and interest rates. I see one coming in. So there's a question here about using your business credit card for personal matters. So you can use your business credit card as you need. The key is really knowing that if you use a business credit card as it's tied to your business, how you use that is going to affect your credit score. So really knowing if you are using that business credit card and you're not paying it off on a monthly basis or you're paying the bare minimum, if that business credit card is tied to your business's credit score, that's what's ultimately going to be hurt from that. So it's really, the key is not so much about how you're using the card in terms of what you're spending it on, but how you're using it in terms of the amount you're putting on it, how quickly you're repaying that loan, if you're missing any payments, and how that's going to affect the credit that it's tied to. So I've got one here that is asking how many years of history would they look at if the business is new. So really, if it's a new business, typically you're looking at personal credit coming into play. Your personal credit score is calculated from when you very first take on credit. So if you got your first credit card at 18, or you started paying, your phone bill shortly thereafter, all of that is going to start accumulating. Different pieces of information stay on your credit report for different periods of time. So we mentioned a lot of the negative type of information that's on your credit report stays there for generally around 6 years. And then the positive pieces can often stay on a little bit longer. But if you are a brand new business, typically what you're looking at is your history of your personal credit. And that's why if you're a brand new business, it is an excellent time to start building your business's credit separately, so that in a few years, if you really need to take out some capital to grow your business, if you have been bootstrapping it and you realize you want some additional help from an institution, then you can absolutely have that history already built up. It's something you can speak with your financial institution about, how you specifically can take on different opportunities to build your business's credit. I have one here that says, do fraud alerts cause credit score damage? So that's something you're going to have to speak with your specific institution about. The alert itself really depends on sort of what's going on behind it, but that's something that you absolutely want to speak with your institution about right away, because what you want to avoid is a situation whereby fraudulent activity is hurting your credit score. I briefly mentioned that it's important to check your credit report and your credit score because maybe there are wildly different numbers changing over time compared to your activity. And that's one of the things that can affect it. If you suspect that there may be fraudulent activity happening and you're seeing a reflection of that in your credit score, absolutely you want to contact your financial institution right away, especially if that's where the fraud alert came from. And you could even reach out to Equifax or TransUnion, depending on the situation as well. So there's another question here about which credit bureau is impacting credit history. So just a reminder, the two credit bureaus in Canada, Equifax and TransUnion, are actually the reporting agencies. And so they themselves per se don't impact your credit history, but they collect information from different companies that will. So we talked a little bit, if you remember at the beginning of the session, about the types of companies that submit payment and repayment information to credit bureaus. So those are different types of lenders, let's say. Or I mentioned the situation where if you're leasing equipment, that company that you're leasing from may feed in information to credit bureaus. Those are the types of things that could impact your credit history, or sorry, your credit score, and your credit as it builds over time. But the credit bureaus themselves are reporting agencies. So really, they're the ones who are collecting all the information. They're putting together calculations and formulas, and they're spitting out your credit report and your credit score. I think I've got all the questions here. So thank you everyone for your time. I'm going to just give you one more tool here where you can look at different information if you, sorry about that. Sorry guys. There are a few ways you can get a bit more detailed information than what we've got today. So if this was helpful to you and you would like a bit more information on your credit score, if you don't know your credit score, you haven't checked it, or you haven't checked it in a while, or if you haven't seen your credit report, there are options for you, and we would love to help you get that information and then get you empowered to build your credit score over time. If you go to www.getloop.ca, you can get free Equifax credit scores and reports, soft hits, so no hard hits that come with that. I know you're probably all now thinking about soft hits versus hard hits. You can get more insights into your business, and you can actually sign up for a free 6-week email course on improving your credit. Once a week, you'll get an email to your inbox with really useful tips and tricks on how to improve your credit, how to assess your credit, different strategies you can employ. It's a very quick read, but it's also something that's excellent for you to build your knowledge over time and start implementing those tactics so that you can see your credit score increase over time. If you have not checked your credit report or your credit score before, I would highly encourage you to go to getloop.ca. It's free tools available. They're educational in nature. They are not going to negatively affect your credit score. So the best thing you can do at this point is get your hands on more information, get your hands on personalized information about your specific credit score. I talked about general tactics that we use. These are going to be a lot more specific to help you and help your business, and also just get more insights to help your business grow. I know that as a small business owner, you probably are a bit strapped for time. You need good information, you need quick information, and you need useful information. You're going to find these things there at www.getloop.ca. So I would highly encourage you to go get some information, get your hands on it, and sign up for that 6-week course to help you improve your credit. The other thing you can do is visit www.smallbusinesslending.ca. That'll give you more information on different types of lenders and lending products available. So when you're looking at your credit score, you can also look at what's available. And for the person who asked a question about interest rates and lending, that's a great resource for you to go to understand what's available to you. So thank you everyone for your time. Thank you for listening. I hope you found this useful, and we look forward to answering your questions in the future. But hopefully you'll feel very empowered to go check out your credit report, learn a bit more, use these foundational pieces, and build the best business you've got. So thank you, everyone.